Hello, everyone. Thank you for joining today's webinar, Congressional Update on Potential Tax Legislation for You and Your Business. Today's program will be presented by Lynn Musinski, Keck. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. All questions pertaining to the webinar content will be answered at the end. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Lynn.
Hi, everyone. Welcome. We're excited to be with you today. As previously pointed out, we're going to talk about potential tax legislation that's been introduced into the House Ways, Means Committee, and talk about how kind of we're foreseeing the DC landscape to look at. For those who don't know me, my name is Lynn. Oh, there we go, Lynn Musinski Keck. I help lead the Federal Tax Policy Group at Witham. I'm also a Forbes contributor, and I also do work as a tax advisor for the S Corporation Association, which is the largest association targeted for S Corporation issues. Most recently in DC, I have testified as an expert witness for the House Committee on Small Business in April of 2023. That was very enlightening, and happy to share comments on that if any interest. And in addition, I also help assist other types of organizations help present their testimony sometimes when dealing with tax implications. So very much appreciate the opportunity to be with you today. There will be potentially some follow-up that you might consider having based off these conversations. And so therefore, I've provided you my contact information and happy to further discuss any particular issues or thoughts you might have that affect you and your business. So today we have somewhat of a packed agenda. I'm going to do my best to make it through, but we will probably get through most of it. We really want to identify and make sure we're communicating with you as much as possible the income tax provisions that are sunsetting this year in 2023 or have sunsetted it in 2022. And then we're even going to raise some, not alarms, but some, I'd say, flags about significant tax legislation that's due to sunset in the future. And so we really want to make sure that we're all aware of kind of setting the landscape of where do we think tax is going in DC over not only the next year, but over the next year, 2 years, 3 years, et cetera. Then we're going to just review the congressional makeup, which I'm sure you're all aware of what it is, but we just want to review a little bit of why sometimes making law within Congress that oftentimes is controlled by nominal amounts can be challenging. So we'll talk about that a little bit. And then we're going to go right into the highlights of the 3 proposed bills. So there are 3 bills, as previously mentioned, the House Ways and Means Committee has marked up, and they tend to be taxpayer friendly. So we'll talk about those. And then I really want to discuss and hopefully enlighten you of how you can make an impact. So part of what's going to be so important over this journey of the next 2 years is really making sure that your voice is heard with your representatives and your congressional leaders. One of the most enlightening things that I was reminded of when I've been in DC these last few months is you have to remember that many of the people who are representing you now were not around or were not involved in the Tax Cut and Jobs Act. And so many of the provisions had reasonings, right, behind them. And we'll talk about one in just a second. But it's going to be really important. I was surprised. The education piece is going to be really important. Are our representatives understanding why these were put into play, what they do, and how they help, how they help businesses. So unfortunately, I always know that owners of businesses wear many hats. This will be an additional hat that we're going to have to help you wear and make sure that voices are heard, whether it be through a variety of different mechanisms that we'll talk about at the end of the presentation. So this is a chart that I, a very high level, wanted to point out where are we in our trajectory with certain significant, as you are all aware, income tax legislation. So we're going to talk about and really stay focused on the first three, but I didn't want to leave out the bottom four, which is essentially you're going to see a repetitive theme through these slides that as of the end of 2025, we're really entering into a totally new landscape for tax. And let's remind ourselves that that's not that far away, unfortunately. And so, you know, the feedback is that it is on the radar of many in DC by your congressional leaders of really having to, you know, yes, we have to deal with the three main issues that are dealing with us now, but there's ultimately a much larger issue that's looming coming in the 2026 taxable year. So the first item, R&E capitalization, R&E research and experimental expenditures. I know this has been very painful for many of our clients, and we are aware of that pain and have been very vocal about it. Unfortunately, previously to January 1st of 2022, we didn't really care if we had R&E expenditures or we had ordinary necessary trade or business expenses because they were all immediately deductible and fell to create deductions when calculating taxable income. Unfortunately, we saw that starting in the 2022 taxable year, we got hit with some bad news. We were hopeful, as I think many of us were, that we would have seen a tax extender last year regarding this particular topic. There is a lot of frustration regarding what's happening in this space, especially when talking about the US's ability to remain competitive in a global economy. But unfortunately, as it exists today for the 2022 and going forward taxable years, essentially now we're required within our business structure to really categorize research and experimental expenditures, identify where they are being conducted, and if they're being conducted domestically, we're having to capitalize those over a 5-year period. And if they're being done in foreign lands, then we have to capitalize them over a 15-year period. This has caused much havoc, has caused a great significant cash impact to many companies, and even came with worse news that, you know, you can't just divide by 5, but they're requiring that you use the midpoint of the year to start this capitalization. So when we see, as we'll go through, we're really gathering up all our expenses, and for the 2022 taxable year, we're only taking, if they're domestic, about 10% of those as a deduction. Very painful for people in that space. Another thing.
Sorry, Lynn, really quick, your slides aren't advancing.
It should just be on the, let me look. Oh,
it's on the cover slide still, sorry.
Okay, nope, let's share. 1 second, guys.
If not, I can quick share my screen.
Is it working now? Okay.
I see the non-presentation one, the back end.
Maybe can you share your screen and I'll work with you. It'd just be easier that way. Thanks, Allison. Okay, so hopefully you're all seeing the grid now. Sorry about that. The R&E capitalization we've covered. Interest expense is big. It's really big right now, and it's becoming larger because of the significant increase in interest expense rates. So over the past 2 years, we've seen 5 percentage points of movement in our interest expense. And what we saw is prior to the TCJA, right? If I paid interest expense, I got to deduct all of my interest expense. Then coming in to the Tax Cut and Jobs Act, they said, well, we need some revenue raisers, and some people might be over leveraged. So we're going to put in a formula that's going to limit your interest expense. For those of you on the call, we're going to ignore floor plan financing, so I apologize in advance, but can talk about that offline. Essentially what they said is, what's your net business interest expense? So offset your interest income against your business interest expense. We're going to allow you 30% of what we would call EBITDA in the US GAAP world, or earnings before income tax, before depreciation and before amortization. So that was your base. So your base was quite large because you didn't have to take depreciation and amortization when looking at your base. You multiplied by 30%, and now there is the amount of interest expense you're allowed to deduct. And you're not allowed to deduct has to be carried forward indefinitely. Well, what has happened, or what shifted in 2022, and what we've seen a dramatic impact on, is that you no longer are allowed to add back depreciation and amortization and depletion when coming up with that base. Instead, you have to look at earnings before income taxes, including your depreciation, amortization, and depletion deductions, and then multiply it by 30%. And so because of the rising interest rates, and because oftentimes many people who are highly financed have significant depreciation or amortization, this really has hurt a lot of companies with their cash tax payments as well. And then something that's kicking into the 2023 taxable year deals with bonus depreciation. And essentially, we've been very accustomed to being able to look at qualified property and take a full write-off or full deduction for that amount. And they are proposing, well, it is currently law, that we have to drop that by 20% each year. So this year it goes to 80%, the following year it goes to 60%, until ultimately in 2027, there is no more bonus depreciation. So those are the three, they're highlighted because those are the three items that we'll really see the House Ways and Means Committee trying to drive. And when you think about that, when they're driving that attention, when you look at those three items, it is not unusual to say that is a partisan, those are partisan movements. What we'll see is or bipartisan movements, excuse me, both sides agree to these three. What we're going to see though, is that the ability to do this is going to cause potential revoking of some partisan, definitely legislation, and that's where kind of the rub kicks in. Other items that I really think is significant to have on your radar, and I'm going to highlight two in particular at first, is the increased individual income tax rate. So many of you might be aware that currently we're at a maximum 37% federal income tax rate. That goes away starting January 1st, 2026, and we revert back to 39.6%. Another significant item, in my opinion, is the 199A deduction. You might call it qualified business income deduction, or the 20% pass-through deduction, all different words for it. But many businesses who are pass-through entities receive this. It's not a perfect item, right? There's a lot of items you have to jump through in order to take advantage of this 20% deduction. But I would caution you, to me, if you asked me 2 years ago, this would be a no-brainer to extend. Of course we would, because of the reasoning why we initially put it into play. And I'm going to say at this point in time, you might have heard, this is definitely not something that's going to be automatically extended. And there has been wording or terminology around the 199A deduction or 20% deduction that it's a loophole and only benefits people who are wealthy. And I think what we're going to find out is there's going to be a lot of education in why this came into play. And as we talked about earlier, that's going to be a big lift, because a lot of people who are sitting in Congress right now weren't around with the Tax Cut and Jobs Act. But as a reminder, right now, what happens is we're allowed a 20% fictitious deduction in relation to certain of our pass-through income. So if we're right now, if we're at a 37% rate, and we get the 199A deduction, we're dropping about to a 30% rate. And so people say, well, that's unfair. But the reasoning why that was occurring is because, as you remember, the big push in the Tax Cut and Jobs Act was that the C corporation tax rate was going to drop significantly. Now, it was anywhere between 20%, 25%, and they landed on 21%. But the reasoning that that bill could not go through without the 199A deduction is because the vast majority of businesses in the United States operate as pass-through items. So they maybe do not have the biggest lobbyist groups, as C corporations might have more in DC, but enough raised their hand and said, this doesn't make sense. You're dropping the C corporation tax rate to 21%, and you expect us to pay the 37%? That's a drastic difference. So they essentially said, no, we're going to provide, again, certain people who fall under the criteria, this deduction, and your effective tax rate will drop to 30 versus 21%. You start becoming more in line. And so what will happen in 2026 is that with nothing being done, if it remains the same as the legislation currently exists, your individual income tax rate will jump to 39.6, 199A will go away, and that's a 10% increase. We're now jumping from 30% to 39.6%, and that's significant. Those discussions have to start now about why that's important, along with these other three items we talked about. The other item I like to highlight on this slide would be the estate tax exemption. And for our team at Witham and for your lawyers, I will tell you, it seems that every time we come to a cliff, and I would call January or December 31st, 2025 a cliff, we are going to see that we're going to have our estate tax exemption cut by half. Please, if you haven't done your estate tax planning, don't wait until December of 2025 to start that process. It's going to be really important for us to work through with your lawyers, obviously, and with your philosophy and your projection to make sure that you can take advantage of that increased exemption amount. There's very, very limited clawback provisions in that space. So I would encourage you, if you do need that assistance, that you move forward with that now. Next slide, please. One of the major things that you don't see in the sunsetting of the income tax provision items is the corporate income tax rate. And so you might be sitting there asking yourself, well, that makes no sense. All these individual pass-throughs are the largest businesses in the United States. They employ the most people in the United States. All of their items are going away, and the corporate tax rate, is that going away as well? And the answer is no. The corporate tax rate, it remains at 21% under the current legislation. There is no sunsetting of that. Whether that was a great move or could have been better thought of, hindsight's always 20/20. It is what it is at this point, and we have to move forward. But many people, I hear this question all the time: why is my tax bill going up so much when no significant tax law has changed? And we just covered 3 of those main topics: R&E capitalization, the adjustment of the 163J calculation, and then obviously the decline in bonus depreciation. So why did we have to do that? So I would, as indicated earlier, when you have a very narrow divide between the parties in the Senate and the House, your ability to pass a law in the Senate becomes very challenging. So essentially in the Senate, to pass a law, you would need 60 Senate votes or a 3/5 majority. And that is very challenging to do, especially in these types of times where we have very partisan parties, right? Not a lot of agreement across the aisle. So it is not unusual for things to be passed through budget reconciliation, which I would caution you, depending on how the next election goes, could be a similar process that we'll have to be going through before the major cliff in 2025. And so what happens through the budget reconciliation process is it's easier to move legislation forward. The first item I would say is you can't filibuster a budget reconciliation legislation. And instead of needing a 3/5 majority, you only need a simple majority. So that's 51. So it's common to be, it's nice to be able to use this type of reconciliation process to pass certain legislation. It is limited to the types of legislation you can look at, including spending, revenues, and federal debt limit. Obviously, the revenues ties to the tax principles, so that's why we can see tax legislation moved through budget reconciliation process. The problem with budget reconciliation is that you have to have a directive, and the directive with the Tax Cut and Jobs Act that was provided is, here, we're going to give you a 10-year window under the budget reconciliation process, but you can add no more than $1.5 trillion to the overall US debt over the 10-year period. And that directive, right, makes you turn on and turn off certain levels, because at the end of your 10-year period that you're indeed going to have to meet this goal. And so that is why we're seeing that there are sunset provisions. Not uncommon for there to be sunset provisions in the budget reconciliation process. As discussed earlier, some people would argue we should have just had the corporate income tax rate to 22 or 23%, as opposed, and made some of these significant pass-through and individual items permanent. But again, that kind of lever is off the table at this point, and we are approaching that 10-year period. I also like to point out to people, budget reconciliation process, both parties have used them. It's a common thing that's utilized in DC. It's not anyone circumventing the system, but it is indeed just a common practice that has happened in all administrations. So I just happen to highlight that on the slide below. Next slide, please. So essentially, here's what you see. We are just highlighting the fact that at the end of the day, they're sending off their proposals to the Congressional Budget Office, which is not aligned with any political party, but purely just there to weigh the numbers. And they clearly met their directive of 1.5 million of an increase in deficit over a 10-year period. Next slide. So I just want to dive in, and I know some of these examples are really simplistic, but I'm going to start building up to make sure we're really understanding the impact. And what I want to build up to you is all of the 3 major items I've talked about at the beginning of the slide that have changed in 22 or 2023 really seem to be having a significant impact on our cash outlays. And so I reiterate, and you'll hear me say it time and time again, it's really going to be important for tax planning to be occurring at this stage, especially because of the unknown of whether any tax extender really can get through this year. And we'll talk about that in a second. So with the R&E capitalization, this is a very simplistic example, but it does happen to our clients. They say, I am purely a research company. I get grants from the federal government to conduct certain research. And in the past, provided I use the grant fund money as directed, I would receive the grant income of 5 million in this example, and I would expense it for 5 million. And now I would have zero taxable income. And that was the expectation. Because of the change in the policy, you still have to include when you receive the grant income of 5 million. And even if you've spent all the 5 million on the proper expenditures during the tax year, they now are limiting you to 10% if it's domestic. So now all of a sudden you're seeing companies say, I've never been in a taxable position before. I'm now in a taxable position. And you ask yourself, well, where's the cash come to pay that tax? And you don't have it because you spent it. And oftentimes, if it's tied with grants, you don't have the directive to use any of that grant money to pay tax bills. So really has kind of flipped the understanding of the U.S. Incentive to conduct R&E on its head. And it is a bipartisan effort because they are aware in many economic developed countries, their desire to increase R&E is seen through their tax policy. So we see a lot of companies say, you know what, in China, if you have 5 million of R&E expenses, we're going to allow you to act as if you had 10 and take a $10 million deduction. In other places, we see patent boxes put together to allow you, once you develop a patent, to really be able to tax it at a very low income rate. And this, many think so far, what has the impact been? It's only been a year, true. But to the extent that this stays out there, it could really have a jarring effect on how the U.S. continues to compete globally. The other kind of conundrum that comes in this space is one of the Democrats' major pushes is for clean energy. And clean energy is going to cause a lot of R&E to be happening. And so it almost is a direct contrast or a fighting mechanism to what the hopes are for the development of clean energy. Next slide, please. The next process, or the next item I'd like to point out, is the interest expense limitation. So the interest expense limitation, as you can see, I think it's really important for people to realize, we have two things happening. One, previously we didn't have to deduct depreciation and amortization while calculating the limitation. But two, as you can see, the interest expense rates have drastically gone up, 2.6% in 2021 to 5.39%. So again, not ideal for companies, because just like the R&E expenditures, we have expenses that are going out the door. We don't have cash, but we're limited to the amount of deductions we can take. Similar frustration has developed over the interest expense limitation because they truly are paying a bank or a third party for this interest expense. But now, based on the calculation being adjusted to now having to include depreciation and amortization in that overall limit, we're seeing that I had, in this example, $103,000 that went out the door that I'm not being allowed to deduct, essentially with the same exact fact pattern. So more and more what we've heard from our clients is, my financing structure has literally not changed. But under the new limitation calculation rules and under the interest expense rates increasing, I am seeing deductions that are not allowed. And they're frustrated, right? Because they're not, if you look to the intent of this, they're not over leveraging themselves. They were allowed the interest expense deduction in previous years. And based on a common trajectory, now they're being limited, and that's frustrating. So we've heard a lot in that space. Next slide, please. And so the last item, which I would just put on your radar because you might not have been as aware of it, because it's happening in the 2023 taxable year. I always joke it's hard for tax accountants. We're always looking 1 year back, but this is really to get us looking forward. Is in the 2023 taxable year, we do indeed no longer see 100% bonus depreciation on qualified property as the law exists today. So if you're estimating that you would indeed have that, that is incorrect, and it's been brought down to 80%, ultimately due to sunset to 0%. Next slide, please. I just want to highlight this, and this is obviously one example, and many examples, will be different. But the cash impact that these provisions are having on privately held or private businesses is significant. So on the left side, you'll see an article I wrote if you want more detail regarding these numbers, but it talks about how private businesses are reaching their tipping point over increased tax bill. And anecdotally, I'll just tell you, I almost feel like it's a frog that's put in what's the saying? You put the frog in the warm water and you slowly uptick so it becomes boiling, and the frog doesn't really know what happened and doesn't jump out. I feel like some of these changes are happening slowly, but by the time we get to 2026, they're going to be so drastic that when you compare your tax bill to 2021 to 2026, you know, it's boiling. Like we're there. So at this particular point, you'll see that based on the three primary items that I've been talking to you about, the R&E, experimental expenditures, depreciation, and the interest expense deduction, this taxpayer's same operations in 2021, their taxable income increased by 80% in 2022 and 115% when comparing 2023 to 2021. Now, in this particular example, a lot of that's based off of R&E expenditures, but it can be driven by, obviously, the interest expense limitation and the bonus depreciation as well. And at the bottom, you'll see the cash impact. And what does that mean to your business when you now were previously looking at a bill of $180,000, and now it's jumped to $350,000 or even over $400,000. That's what we're grappling with today to try to fight to make sure that doesn't happen and really not only inhibit our privately owned businesses, but also inhibit our growth in the economy and potentially push many into recession. Next slide. So here we are to polling question number 1. So I'm going to toss it over to Allison and her team to get that out.
All right, I'm going to launch the first question. Do you anticipate your business having to pay more federal income tax in 2023 due to TCJA provision sunsetting?
So I see that we're collecting the responses now, just so you know, we're still with you. And we're going to give you another about 5 seconds to answer that poll if you haven't already. Make sure if you need CPE, you're answering. Okay, I think we can close out the poll. 53% said yes, 13% said no, and 21% said unsure. So I think, you know, all of that is, you know, over the vast majority are anticipating indeed that they are expecting more cash tax payments to have to be made, which I would say is probably a true fact pattern. We'll go to the next slide. The next slide, we're just again reminding you what is happening right now in the Senate. And so as they're advancing to the next slide, you'll see that the Senate is made of 51 Democrats and 49 Republicans. There was a potential runoff in Georgia we thought would be 50-50, but ultimately 51-49, 3 yellow dots being independent, including Kyrsten Sinema from Arizona, who really, I would say, if you followed the Build Back Better plan, was really an advocate for privately held businesses and saying and being willing to take the data and move that data and hold her vote for purposes of making sure people understood how drastically negative it could be. So hoping you know, that she's still an advocate, I think she is, but also being aware that you know, potential runs could be difficult going in the future. But so very, again, as we talked about earlier, very close, you know, division between Republicans and Democrats. So we have our majority leader, Chuck Schumer, who's a Democrat from New York, where I'm from. And then I also point out we have the Senate Finance Committee chair, and you care about the Senate Finance Committee chair because that's where a lot of this tax legislation from the Senate comes from. and they're very actively involved in this space. Ron Wyden, a Democrat from Oregon, is currently the Senate Finance Committee chair. Ron Wyden did not have fantastic things to say about the House bills coming out of the House Ways and Means Committee. And if you're seeing again and again, the Democrats are really trying to push the child care tax credit. And when we start talking about the numbers, I'll start telling you a little bit about what we saw with the Build Back Better plan for the amount of investment the enhanced child tax credit would have versus some of the discussions now. So it is important to realize that on the Senate side, it would be much harder to get through this legislation. And so some people say, why do you bother then? Why are we talking? Well, we're talking because there is, as talked about before, bipartisan support for many of these bills. Many businesses, many leaders around the country are going to their senators and their congressional leaders, talking to them and telling them about their impact, or what I like to refer to as their story. When I testified at the House, I heard a lot about, well, what is that? How does that impact your clients? They're not so much concerned about maybe the technical law, but without that cash, I couldn't do X. I couldn't give back to my community. I couldn't expand my business. I couldn't hire more people. And that is definitely something, those triggering points are definitely important to them. From the Senate side, we have the Minority Leader, Mitch McConnell. I think, again, we're in this tie-up here between Mitch McConnell and the Democrats, Chuck Schumer, we're looking at legislation like R&E, interest expense limitation, and bonus depreciation, which really are bipartisan initiatives. And then when you talk about the enhanced child tax credit, that's really a partisan initiative, right? And so I think that Senator McConnell is struggling with why, when we all agree on three, are we tossing in a partisan issue? And so where that falls out, we don't know at this point. I'd also highlight the Senate Finance Committee ranking member is from Idaho, Mike Carpo. And again, the balance here is really tight. And so it is something we need to be aware of, that even if we get this through the House, we would have a challenge in the Senate, right, to get it through. But I do think that most people are hopeful that if we get it through the House, it really will start the representation and the discussions that are needed to get something through Congress by the end of the year. Next slide. Oops. The House is very different. The House is the opposite, right? Controlled by Republicans. You might say, oh, 222 versus 213. It's got to be so easy, right? To pass laws out of the House into the Senate. And all we have to do is remind you of, the Kevin McCarthy appointment to Speaker, to know that that is truly not the case. Things that I would point out: we do have Speaker Kevin McCarthy, and we do have the House Ways and Means Committee Chair Jason Smith from Missouri. I would say I got to meet with him and speak with him, and I do think he's level-headed. He has changed things a little bit, and what I call, he's doing road shows, which I think is fascinating. And I think I would encourage any of you that can participate in them to do so. So instead of saying, right, the original mantra was all of you need to come to DC and talk to me, Representative Smith has said, no, you know what, we're taking the House Ways and Means Committee and we're coming to you. So they've been in Atlanta, they've been in New York, they've had 4 road shows so far. And believe it or not, those roadshows are extremely important on what they're bringing back and what they want to talk about in DC for tax legislation. Really excited for that additional vantage point or additional discussions to occur. We have on the Minority Leader, Jeffries, who's a Democrat from New York, and the House Ways and Means Committee ranking member is Richard Neal, a Democrat from Massachusetts. Again, they also brought up the child care tax credit as wanting to expand it. So again, I would say, yes, there is a majority in the House, but there are factions within the Republican Party. As obviously some of you might be aware of the Freedom Caucus, who is a faction of that Republican Party, and they tend to be very staunch, financial, fiscally responsible representatives. And so I will say, from my knowledge, Representative Smith has done a great job in trying to push in to all those factions before bringing any bills to the House Ways and Means Committee, meaning trying to iron out the details of these particular items before they fester in House Ways and Means Committee, and therefore the bill falls out altogether. So he is trying to unite the Republicans. However, it is challenging, right? Because ideally, you're not allowed to lose that many votes. The other thing I thought was fascinating was in DC is, a lot of people, including myself, thought, that when they did elect the Speaker, McCarthy, it was not great, right? It was kind of not a good look for the Republican Party, and it took forever. But what surprisingly, and I thought this was a great insight, was they said, yeah, but because we did that, we had to get rid of a lot of the tension and the arguing points that would have pushed themselves down the road into this discussion regarding tax legislation or other legislation, and really address them at that time. And so they're feeling stronger, and they're feeling like they can move better now at this point. Next slide. We're going to jump into polling question number 2.
Have you talked to your House representative or senator in the past 18 months?
Yeah, so as you're polling, one of the things that's reiterated time and time again when we talk about tax legislation and tax law is we really need to be hitting both sides of the aisle. I think that making both sides of the aisle understand the importance of these provisions of how you operate your business and how you conduct your business. And so, I think it's, it is as important to meet with your Democratic leaders as it is your Republican leaders, or vice versa, and really tell them your story. And as I see these polling questions coming in, we'll give you about 10 more seconds. We have 66% of you who said no, would they really listen? And I will say, I do feel that they are very open to the story. So meaning they want to hear from you. They want to hear if you're in their district. They want to hear that you are, because of these items, you are not able to expand, or you might have to close your doors. Many were taken aback when we said, this R&E capitalization policy, we have companies who can't pay their tax bill and are looking at closing their doors. I think that was a very strong statement for them to hear. I don't think they realized that at all times. So I think that, I really encourage you. I see, yes, we speak with them often. So excited to hear that, the 2%. Yes, but only a few times. That's still okay, 4%. But 6% of the whole audience saying yes is really a low number. And as I said before, a lot of these private business tax legislation initiatives are going to, unfortunately, have to be pushed by you and your teams. So it's really going to be important as we continue to get movement. Okay, so we got to jump in. Next slide, we're going to talk about, well, what are the acts and what do they look like? So there's 3 different acts that were passed. We're going to go after the Build It in America Act first. Not surprisingly, right? Everyone can get around this one. We want the research and experimental expenditures to go back to immediate expensing. And we don't want to have to capitalize it over a 5 or 15-year period. Included in the bill for those people who might say, well, I still want to take it over 60 months or 5 years, they give you that option at the election of the taxpayer. They did make very specific in the bill that also they are going to say that any software internally or externally developed will indeed be considered R&E expenditures. I think that's just to make clear, previous to the law change, there was a revenue procedure that guided us in that space. But now they're just going to put it into law, which I think is great. For those of you who remember the days, and this is a little technical, so I'll go by quickly. Back in the days where I took a research and experimental expenditure full 100% deduction and a research and development credit, I couldn't double dip. So I had to take a haircut on one or the other. That would be back in play if indeed you do have immediate R&E expenditures. The other item I point out is it's not unusual for some startup companies to actually make a 59E election because they're in a loss situation already, and they say, I don't need to immediately deduct these expenditures now, nor is 5 years enough, so I want to take them over 10 years, and that's back in play as well. The big question for me, probably a big question for you, was, Lynn, what if this passes? Like, what do I have to do? Do I have to go back and amend if I've already filed my 2022 tax return? And the answer is they're giving you the option of either going back and amending or to essentially take any of the capitalized asset that remains at the end of the 2022 taxable year and immediately deduct it in 2023. Very nice, right? I like the option because some people don't need to go back and do the amendment. And obviously amendments are administratively burdensome. So we appreciate that. The other thing I would point out is we're at that date again. Yes, we want to pass this until December 31st, 2025. So again, just setting up that cliff in 2026. Next slide, please. For calculating interest expense deduction, the general rule is that starting as of December 31st of 2022, so we really wouldn't kick in until 2023, they're going to allow you to, again, calculate the limitation on EBITDA, so I can add back my depreciation, amortization, and depletion, versus EBIT. And so for those of you who are saying, well, wait, why 2023 and not 2022? Some people might not need it in 2022, but they do allow you an election, right? So if you're saying, well, I really do need it in 2022, and I would go back and amend, that you can elect to apply it retroactively. So that's in the law as well. And then obviously, again, going through, they're saying we'll allow us to calculate on EBITDA again up until 2025, creating that cliff for us. Next slide. Interestingly enough, where they are willing to let us receive 100% of bonus depreciation until, again, that magic date of December 31st, 2025. And then thereafter, instead of scaling down from 80 to 60, they just say, nope, we're immediately going to scale down to 20% for the following year, and then it's completely going to go away. So that's what's being proposed around bonus depreciation. If you've been in this area for a while, you're aware that bonus depreciation is oftentimes played with. So I don't think, similar to what we're dealing with now, that those items of 20% to 0%, will they come to fruition? Probably not, but we never know. Next slide, please. So some people read this incorrectly. A lot of you on the call might be dealing with a Superfund excise tax, which has to do with tax on certain chemicals or chemical substances. And essentially, we were hopeful that that would be removed. It's something that was put back in the 80s that got reinstated in July of last year. But unfortunately, the termination in the Build It in America Act is only associated to crude oil and petroleum products. So chemicals and chemical substances are still on the table. The other item that's included in this act is you might be aware that foreign tax credit regulations came out and are very specific on what type of foreign tax credit you're allowed to utilize based on the country and what type of tax is being raised. And so here they were just putting in that for certain countries located in North, Central, or South America, right, wanting to build up our specific area, they said we would indeed, regardless of whether they met those regulations, we want to take those as foreign tax credits. They did exclude Cuba and Venezuela, which is a common theme you'll see throughout. Next slide. Also similarly, farmland, farm ranch land, they do have some concerns about people selling farm or ranch land to countries of concern. I've listed the countries of concern there. And so there's an ownership test that has to be met, but if so, they want to assess a 60% excise tax. They want to make sure that certain ranch land and U.S. farmland is not controlled by these entities of concern. If you look through all that, and we can go to the next slide, you look through all of that and you say, Lynn, that seems reasonable, right? Like, yeah, we can get on that, bipartisan, right? And here's where we come into the partisan. And so to pay for this, right, we have to remove, right, some of our expenditures. And the ones that they have put up for repeal, meaning they would completely be removed, has to do with the clean energy credits regarding electricity production, electricity investment, previously owned vehicle, so a credit for previously owned clean vehicles, and the credit that's currently in existence for commercial clean vehicles. For those of you who say, Lynn, what's going on? I already bought those vehicles and want that credit. There is a transition rule that's provided in the Act, so just something to be aware of. Next slide, please. One of the items that probably wouldn't be accepted too well by a lot of the automobile manufacturers is within this, they do have a significant change and modification to the clean vehicle credit. So if you remember, the clean vehicle credit is up to $7,500 as it currently exists. There's 2 tranches of the credit, and that credit is based on whether you meet certain battery components or critical mineral tests. They essentially kind of said, we don't like that idea. We're going to base the credit back at $2,500, and then you're going to be able to receive an increased credit to $7,500 depending on your battery kilowatt hour of capacity. But essentially, we really want 80% of the battery critical minerals to be in the United States or a country with a free trade agreement. And we want the components contained in the battery to be manufactured in the United States, and this was, or in North America. And this was something that Joe Manchin was not happy with when the final bill came out with the clean energy credit. He thought we were being too lenient on those two bullet points. The other restrictive item is, if you remember previously, they only allowed a manufacturer to produce $200,000 of these vehicles. They want to put that back into play, and many of our manufacturers were close or already capped at that $200,000 limit. So it will be interesting to see where that lies. Next slide, please. So altogether, we're seeing that, you know, the TCJA cliffs, those 3 items that we really want extended, is going to cost us about $47.4 billion. The supply chain security is going to cost us about $11.5 billion, and then they're estimating that they're going to bring in $216 billion. For the repeal of the credits. So overall, this one particular bill would actually bring in a positive $156.9 billion. Obviously, that $216 billion is the partisan issue. Next slide, please. 2 other bills, real quickly. I just would throw out to you that this reporting requirement threshold has been painful. Again, it says for the 2023 taxable year that the information reporting threshold will be 600. They're proposing it be increased to 5,000. So think about your 1099 miscellaneous. A lot of people are frustrated with this decreased reduction. They're not quite sure what it's going to result in, but just more administrative and fee work for businesses. So that was the proposal there. And then for third-party settlement organizations, they would again raise them to say, you know what, you don't have to report unless the transaction exceeds 2 tests, one being that it's over $20,000, and the second being that the number of transactions exceeds 200. So very much an administrative ease. Next slide, please. Real quickly, the last 3 items in the Small Business Jobs Act, they would say that qualified small business stock, which if you are aware of it, right now is only utilized in C corporations. They say, no, we think the exclusion should also extend to S corporations. And they'd also allow you an exclusion amount for a holding period starting at 3 years as opposed to 5 years. They want to uptick our 179 expensing, which is expensing allowed for immediate expensing for small businesses. And they want to establish qualified opportunity zones in rural communities, which is something that I think, to be honest with you, could get bipartisan support. Next slide. The last one, the Tax Cut and Work Families Act, really doesn't have to do with businesses as much as it has to do with individuals. And they said, you know what? We don't want it to be called the standard deduction. They want it to be called the guaranteed deduction. Nothing significant there. But they would like to provide additional deductions of the guaranteed deduction or standard deduction for the 2024 and 2025 tax year. So you get to add $4,000 if you're married or $2,000 if you're single to your standard deduction, provided your AGI doesn't exceed a certain amount. Once your AGI exceeds the amounts as listed on the screen, then they're going to start reducing your additional deduction. So the next slide is really where we get into what's the total impact of all 3 of these bills. So yes, building it in America brings in 156, but the Small Business Jobs Act is estimated to take away $81 billion from the budget, and the Tax Cut and Working Families Act is projected to take away $96.7 billion. So altogether, $21 billion of removal. And at that, we're going to start our next polling slide.
Which business provision would your company most benefit from?
And while you're answering this question, I just, I'd like to bring up sometimes people don't remember, well, what is the US federal budget, right? How much do we spend a year? So when you're talking about the yearly budget, it's on average about $6.5 trillion for the year. And part of that is discretionary funding, which you might have just become more aware of with the negotiations that just recently occurred. But so 21 billion, some people say, well, that's not bad when we consider, this $1 trillion budget that we have. I would caution you to say, though, you have in the Republican Party, as we talked about earlier, hawks, right, that are very fiscally responsible and don't want to add any additional debt to the budget. So that's kind of the win that the House needs to get the bills passed and moved to the Senate. Not necessarily for the Senate to agree upon, but to set the floor for tax negotiations. This was a significant step. If this didn't happen, if bills didn't come to the House, and if bills don't get out of the House, I don't think we're going to see any tax legislation in the current year. So pushing this through the House and supporting and making sure our representatives are supporting it is going to be a significant part of this process. So 40% of you said bonus depreciation was a big issue for you. 20% noted the immediate expensing of R&E. 18% are concerned about the interest expense limitation. 17% relaxed information reporting requirements. So those 1099 myths, totally understand that. It is a big issue. And then 8% the 1202 benefit, which, yeah, I think that would be amazing, right? We would all welcome that. And I have an article on that as to the reasoning behind that, but why now is the time that should occur. And it's really based on the tax rate differentiators between flow through and C Corps. We're going to go to the next slide, and we're going to go through 2 slides, and then I'll give you your last polling question. But if this is the one thing you take away, even with these tax bills, we are all pointed to 2026. So for those of you who are like me, that's not that far away. Seems like time flies by. But so really the vibe or the items when you talk to the leaders about what's your priorities and how are you approaching these next few years, this year is going to be a focus on extenders. But 2024 and 2025, I've heard so many people reference significant rehaul. What that is in debate, depending on who you talk to. But we need more revenue. And so one of the things I always like to point out, we were able to meet with a director at the Congressional Budget Office, and it kind of sets the tone that sometimes we need to take that 100,000 foot view out to really realize, like, oh yeah, like there is going to be major tax reform in 2025, not because of a political reason, but because of where we are right now with our federal budget. So a couple things I would highlight. For the current year, the CBO, and this is all public, it's on their website, has noted that the revenue coming in is smaller than expected. Why that I say be cautious about that, that's maybe not necessarily true, is, as you know, all those storms went through California and they got a delay in filing for federal and California. I think there's only one county that didn't. So that could be tied to that. Could it make it all up? We don't know, but something could be tied to that. They have been very open, the CBO has, even without these House bills, that they were already going to have issues with the US budget in 2025 when you had the 199A sunsetting, the 39.6 going up, et cetera, and the exemption going down for the gift, state and gift exemptions. So really what they're saying is, even if we did nothing, right, and we waited until 2025, we were still going to have an issue. So that's on the table. The other item that they pointed out is, the impact of the interest expense has not really hit the US federal budget yet. And that's going to be a big item. So there's a 6-year cycle that normally goes through with the debt. And so we're just starting to introduce these increased interest expense rates at the federal level. And so what that means is we're going to see very significant impacts in the US budget related to those interest expense payments in the next few years, which again is probably why they're saying, even if we did nothing until 2025 and allowed all of the provisions to sunset, we're still having an issue. believe they do think that the fiscal budget crisis is no longer on the horizon, but that it's here. Much of that is coupled because of the rising interest expense limitations. And so they essentially said that we need a saving of $5 trillion over the next 10 years to hold the debt to GDP ratio. And so if you're aware, the debt to GDP ratio is something that's often monitored. And right now we have the highest debt to GDP ratio that we've had in existence, and no one really wants to see that higher. Coupled with this, the Social Security Trust Fund is projected at this point, based on CBO, to be exhausted in 2033. And so all of that's pretty pessimistic, right? We have a lot going on, and potentially a major tax rehaul is going to be required. And so I would say we are either part of that and in those discussions, or we're watching from the sideline. And we really want to be part of those discussions. I would still point out, many, not only the director, but others point to, we still are the United States of America. We are still a great country. We still have people who are flocking in, and we still have capital that's flocking in. So both those are strong factors for us to be confident in how we can carry forward as we go in the future. Next slide. I will talk about this, but let's launch our last polling question if we can. And while you're answering that last polling question, I really want to talk to you again. This is not a fight that someone else is going to take up for you. Obviously, Wisdom fights a lot for this, but the requirement or the need for businesses and for individual owners to become engaged in this discussion is huge. Again, multi reasons. The first being that we have relatively a significant amount of new representatives and senators that need reminding of why certain legislation was put into place, and what the TCJA, why certain things were moving. But we also they need to hear your story. They need to hear, some were taken aback when they say, I literally have not changed my financing structure, but now this year I'm not allowed to deduct $200,000 of my interest expense versus last year I got to deduct it all. That was kind of an aha moment I felt that was happening. But really, talk to your representatives, talk to your senators. They will listen. I promise you they will listen. And I think on both sides of the aisle, they need to hear our private story, right? The private company's story. Not as many people are active in that space as you might have hoped. Don't assume, I always say to people, that someone else is doing it on your behalf. And that doesn't mean you have to take a trip to DC. Follow the road shows that the House Ways and Means Committee, Representative Smith is having. I think they've scheduled another one in the next couple months. You can consider setting up a conference call. You can email your representatives with your why story. If you need help emailing, coming up with a standard, hey, these things are important to me, and we'll give you a little bit of the law and you give your story, which we have helped people do. We're happy to help you do that as well. The other thing I would strongly encourage you to do is, most of you on this phone probably already are associated with a national or state association. When I was down there, I got to talk to the Engineering Association, the Roofers Association, believe it or not, which is a large association. There's tons out there, and they are really pushing hard and lobbying on your behalf for maintaining a strong pass-through entity community in the United States. And so I would say, continue to utilize them, continue to work with them. And then the last but not least is tax planning. Tax planning will be a must, okay? Tax planning has to occur. Please reach out don't be caught by surprise. The last thing we ever want to do, two things, is for a large tax payment to come through without us having communicated with you, and for a large tax bill from us to come through without having communicated with you. We want to make sure that we're clicking the levers to the much as possible to control your impact before, if we don't get any tax extenders. And there's ways to do that. But again, that's going to be an important part for you to work with your tax advisors while doing this. So I gave you some additional information on the debt limit at the end. We didn't get to it. I didn't know if we would or not. Really fascinating stuff. But I think I'm trying to set your scene. This year, let's focus on tax extenders. The next 2 years, we need to think outside the box and think of some significant changes. which I know some of our leaders are already doing in DC. So the last question, we had great responses. Over 77% said, please keep providing these webinars. We will. Please, 7% said, yes, I like these webinars, but not sure what to do next. You can reach out to me. You can reach out to your tax professional providers, and they can help you like with those discussions, with trying to represent your story. It's really going to be important. And we're here to help. And we're taking a lead with you in this, that we know this is important. And so we hope to continue these conversations with you and with the larger community. So with that, I wish you a great week. It's been great having you with us on the call today. And hopefully we'll talk soon. So take care.
Thank you for attending our webinar. Please remember to take a moment to complete the online survey. Thank you and have a great day.